Let me just describe what the normalization process is. So, like we talked about earlier, while you're looking for that, the process of normalization is the long-term rates going back above the short-term rates, right? And actually, to this day, we've had the longest, steepest yield curve inversion between the 10-year Treasury note and the 3-month Treasury bill in its recorded history. So, what that's telling you is the marketplace has trusted the Fed. They trusted the Fed so much that it created the longest and the steepest yield curve inversion in its recorded history. But if you go back and you look at the chart, and on that chart, Opti, it's like the 10-year minus the 3-month. It's a Fred chart. There's two red lines. I talk about normalization, and there's what's called a interest rate spread, right? So it'll be the difference between the 3-month bill rate and the 10-year note rate. Well, historically, once the yield curve uninverts, the spread between the 10-year and the 3-month, it ranges between 2 and 4%. Well, that's really important because right now the 3-month bill is at 5.5%. So if we get a normalization, in other words, if enough people say, I don't believe your 2% inflation target, the Federal Reserve starts to lose control of the long end of the yield curve. Like in that one tweet, his comment was trying to figure out what's happening with the long end of the curve. Can't just figure it out, because he can't say out loud, oh, people are starting to lose trust in us. People are starting to question our 2% target. And as they question 2% target, those yields have to rise because those people are looking to be incentivized. And to be incentivized, the real rate has to be positive. So those yields have to keep going up. Well, with the 3-month bill at 5.5%, if we normalized, the 10-year would go all the way up. Yeah, so you can see the 10 years, the candles, the 3-month is the green line. If the candles go above the green line and the 10-year rate goes above the green rate, the historical spread, in other words, there's going to be a crash. Treasuries will sell off so fast that it will be hard to comprehend. And it will be 2 to 4%. So 5.5% plus 2% is 7.5%. And 5.5% plus 4%, right? Because that's the spread, 2 to 4%, is 9.5%. So you'll see the 10-year note post normalization shoot to 7.5% all the way up to 9.5%. And remember about what we first talked about. The higher the rate goes, the larger the deficit. The larger the deficit, the more they need to print. The more they print, the larger the inflation number. The larger the inflation number, the more real yields go negative. So this is the debt spiral that people are waking up to. And that what you want to keep an eye on is actually, Opti, I know you can pull this up fast. If you pull up a tab and just type in Fred, F-R-E-D, 10-year minus 3-month, and click enter, it should be the top result. And everybody will be able to at least visualize it and see what I'm talking about here. Because what this chart does, yeah, beautiful. Now just zoom it all the way out, like at the bottom, pull that, yeah, go straight down, pull that thing there all the way out. There we go. Okay, so what you'll see is, and actually what I want you to do is pull that same bar back so that I can show people there that very first thing actually did go. So not that one, the one on the right. Pull that one on the right all the way back to like 1985, all the way back. Keep going, keep going, keep going. Good. Okay, see how the rate went, it did go negative there. So I just wanted people to, I don't want people to be like, hey, CJ, what you said wasn't true. No, there was an inversion and then there was recession. Okay, so now you can zoom it all the way back out. I don't know why it does that, because you know why? The government can't even code charts. That's why. But it doesn't look like it was inverted there, but it was inverted there. So you have the inversion, the normalization, recession. And then in the 90s there, inversion, normalization, recession. The gray shaded areas are the recessions. Then in 2000, inversion, normalization, recession. Inversion, normalization, recession. And then COVID, inversion, normalization, recession. So right now, look how steep that inversion was. That was the steepest inversion in the history of the recorded relationship between the 10-year and the 3-month. Now, if you measure the amount of time of these inversions, right now, we are in the longest lasting inversion in the recorded history of the 10-year and the 3-month. What does that mean? That means that the market has trusted the Fed. But what the Fed officials came out and said today is, We can't understand this big V shape here. We don't understand why we're getting this V-shaped design and we're heading back towards the zero line. Why are we heading towards normalization? Why are long-term yields going up? Well, because the free market is calling your bluff. The free market is saying inflation isn't 2%. Therefore, in order for me to continue to lend to you, I need higher rates of return. And they're going to sell that debt until it gets to the point of that rate of return being real. But then if they really know how to do the math, they're going to understand, oh my God, when it goes up to 7.5 to 9.5%, well, the number I have to subtract from that 7.5% is going to be larger than what it is now. It can never get positive. They will never be able to make real yields positive. That is like the biggest piece of news that nobody is talking about. There's no way, because of the $34 trillion of debt, the $211 trillion of unfunded liabilities that all need to be financed and rolled over, plus the ongoing deficit budget that they plan to continue to grow, there is no way to get the real yield to be a positive number. There's no way. They're stuck. And this is what people need to understand. And once they do, it's you're not going to be able to get out of the dollar fast enough. You're going to see a crash. You're going to see yields shoot up to double digits, and not just 10, 15%. They're going to go Weimar level, 20, 30% yields. And unfortunately, some people will still get suckered in. But look no further than Argentina to understand that even if you put the interest rate above the rate, I think their interest rate is like 136%. But their real inflation, now the government inflation rate is smaller. It's like 110%, but that's a lie. They're lying about their inflation rate too. Real inflation in Argentina is closer to like 200%. So it doesn't matter how much you raise the rate. You could literally be paying people 136% APY, and it wouldn't matter because you're paying the APY with diluted tokens, with diluted fiat currency coins that have no real, you can't create value out of thin air, right? So they steal their value from all the existing tokens. That increases the inflation rate and lowers the real rate. That's where we are right now. That's what's important for people to understand. And if I were you, I would be keeping an eagle eye on the 10-year note rate minus the 3-month bill rate, because when that normalizes, that will be the catalyst to long-term yields skyrocketing. And then investors having to ask, what the hell just happened? How did this just happen? And what are the consequences? And what are the real numbers? Right? Because nobody really pays attention till they're forced to pay attention. Just like nobody really cared that the banks were insolvent until people wanted to move their money from the banks to the money market funds. Then it mattered. Well, very soon it's going to matter that they don't have control of the yield curve. And if they try to do yield curve control, money printing, right? More inflation. There's one solution they have: inflation, 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 not deflation. Right? Everybody on the sidelines waiting in their money, waiting for deflation. We are in an inflationary recession. Remember the GDP chart. We're in a recession right now. We are about to be we're in an artificial depression. I'm giving them that. Okay, that -10 was because of the lockdown. It's artificial. But real rate is negative. The real growth rate is negative. We have not had any economic growth at all. We've just been shrinking less and less. We're still trying to recover. And they're trying to take advantage of that. There's nothing they can do to get out of it. We're in an inflationary recession right now. Economic growth is negative and prices are still going up. Jay Powell told you himself, the costs are going up. The prices are going up. Maybe one day they'll have to sit down and ask, dang, what causes more inflation? Increased cost structures for businesses or lower interest rates? Because I think what we're going to find out is that increased cost structures anchor inflation, and that's not transitory. That's not transitory inflation. That inflation is not going away. If you have monetary inflation, then maybe there's something you can do to try to dampen it. But if you have structural inflation, it's not going away. And that's the next inflation wave. The next wave of inflation is going to be based on the structural inflation through the cost structures of businesses and families and the government deficit increasing. And then they're going to lower rates and print more money. And you're going to get it from both sides. You're going to have structural, sticky inflation, which isn't going to go away overnight. And then at the same time, you're going to have monetary inflation, and you're going to get a double dose of inflation. And that will force the government to even admit to new all-time highs of inflation. even though they don't want to, and they're incentivized not to tell you that. They'll still be forced to tell you that. And at some point in time, we have to break off of their data and not take their interpretation of the data and get the real data so that we can understand what we are incentivized to do by the marketplace, which is always going to be based on the real yield, not the nominal, the real yield. So for everybody listening, make sure you're calculating your real yield so that you can understand how to position yourself and how to allocate your portfolio as we go through what the Fed is calling this higher for longer streak.